if you're like me, you're probably sort of a bit like this, so we'll crack through. I thought I'd get my, we were forced to put Faraday references in here, so I thought I'd get mine in early here.
Invited,
so,
not forced, invited.
Invited to. So I got grade B physics, so we're struggling a little bit. But robo-advice and profitability, attracting opposite or poles apart. The other conversation I'm pretty sure has happened in this room is the fact that you can't destroy matter, which is kind of like my slides. I know some of you have seen these before, and they can't be destroyed, they go there forever. But there's two other reports I'll reference as we go through here from the US. So my topic that Heather's asked me to touch on is what's been happening in the robo-advice space in the US. Is that a kind of precursor to what might be coming here? Some would say Vanguard's cracked this in the US. You know, we might have a slightly different view, so I'll touch on that as well in a whistle-stop tour of these topics. So robo-advice, what is it? What have been the conditions for growth? How is it evolving in the US? Is there a path to profitability, and is it going to replace the incumbents we see in the US? And what might be the clues for what might be coming here? Robo-advice is one of those awful terms. It can mean lots and lots of things. It kind of sits on a spectrum. On the one end, you could say that all-in-one funds like target date funds are kind of robo-advice. The advice is embedded within the product. Most of the US DC market runs on target date funds now, so lots of people benefiting from that kind of robo-advice, if you like. All the way over to sort of white glove, high touch, personal financial advisors as we would know them here. So when we talk about robo-advice here, we really talked about the sort of pure digital play in the middle. Although you'll see there, we sort of talk a little bit about hybrid advice as we go through here as well. So takes your pick as to how you define it. Lots of these springing up all over the world. Sorry, Anthony, I've still got eVesta as eVesta there rather than your new name. But lots of these sort of springing up over the world. The two probably most quoted from the US, Wealthfront and Betterment, are probably the two that have sort of pressed on. So I'm going to sort of reference those two as we go through here as well. So what were the conditions for growth here? So I think a couple of things. If you are interested in this topic, there's a fantastic report written by Mike Goldstein, came out earlier this year, which, see me afterwards and I'll point you in the direction of it. But some really interesting data in there around sort of demographics and the way the market's evolving. So a few things here, and I'm going to touch on a few of the topics we've already touched on this morning. Clients are getting older and so are their advisors. So there is this theory that sort of as clients die, so are their advisors, and there isn't the sort of youth coming through in terms of that's going to fill the advice, who's going to provide advice capacity going forward. We also see some differences in trusting technology more than people when managing money. Millennials think they will trust in technology twice as much as boomers do. So you think, right, so there's not going to be any advisors around. Younger people think there's going to be more trust in technology. A couple of other things, as we've heard, it's still pretty hard to beat the market. The data, forget the religious debate, it's still pretty hard. And I think investors are wising up to the fact they've been paying lots of money for outperformance that hasn't come through. So we are seeing, particularly in the US, this mass migration from high cost to low cost solutions. Just so happens that also means active to passive, but it's a shift from high cost to low cost going on. And overall, the price of funds has now come down. Sort of passive funds are now cheaper than the institutional prices of many other funds out there. So people are shifting from performance focus to price focus in terms of how they do this. Look at age cohorts. Younger people also think that they're going to be more reliant on technology going forward than the investment professional. The older generations still think the investment professional matters, but it would seem that the younger generations think technology is going to matter more. And we can still see that for lower balances, the price of advice is still pretty high. It gets cheaper as with bigger balances, as you might expect, but it's still pretty a high price thing. So I think what we saw here is some of the insurgents thinking, hang on, so advisors getting, nobody's backfilling here, market's still pretty hard to beat, younger people more susceptible to a technology offer. So I think that's what's encouraged a couple of people into the market. And a couple of the early ones, I think, really focused in on, right, we're going to be a real robo play. And not only were they going to be a robo play, a technology play, we're going to push us against something. And the thing we're going to push against is the human advisor. So I just thought I'd show you these. Hopefully the sound is on. And I thought I'd show you these as a couple of interesting examples of how, particularly one firm, were positioning themselves in the early days of their robo offer.
You've made some money. You want to invest, and you're wondering how to get started. Traditional financial advisors have high fees, high account minimums, and try to sell you products that benefit them, not you. But at Wealthfront, we know there's a better way to do it. We've taken the same modern portfolio theory that drives some of the most advanced financial advice, and we're making it available to you. We use risk assessment algorithms to define the level of risk you are comfortable with, and from there, build highly individualized plans. We show you your plan so you can see what you'll own before you commit. Then, just fund your account, and we'll open an SIPC insured brokerage account for you. You can even transfer your IRA or 401k to invest in your plan. We continuously monitor your portfolio and periodically rebalance your account to keep your plan on track. A dashboard shows you everything you want to know about your investments. And what's more, you pay 75% lower fees than typical financial advisors. Wealthfront, the financial advisor for the new generation.
Pretty slick looking at it. I don't know if you see that demographic there. Interesting. So all kind of young millennials. So as it happens, all their clients are about 65 years old because they're the ones with money. Yeah. But you can see how they're pushing against the sort of the human financial advisor there. Yeah. Take a look at this one.
So I'm looking for a simple way to invest my money. What makes you the best?
I'd have to say it's our mobile investment platform.
That sounds interesting. What kind of software do you...
Bring in the platform. As you can see, the platform allows us to do business anywhere.
Couldn't I just use my smartphone?
The fax machine has a phone.
What about email?
Faxing is forever. All we need from you to get started is your last 25 years of bank statements faxed to this number.
Is this how faxing works?
We're going to set you up with a great retirement plan, kiddo. Same one we use.
You don't need that guy. With Wealthfront, you get a sophisticated, low-cost investment portfolio online in just minutes. Go to wealthfront.com to start investing today.
Okay, so you don't need that guy, yeah, because you've got these now. Well, actually, it turns out that you might. Because when you look at the evolution of those, Betterment and Wealthfront, actually they both moved more into the hybrid space now than the pure digital play. Yeah? And I guess the question here is, in this rising sea of technology, what is the dry land for the human advisor there? And I think as we were hearing earlier on, you know, the science journals would still have you believe that robotics is difficult, and the three things it can't get right at the moment are empathy, trust, and fine judgment. Now, even fine judgment, I'm not sure about actually, because when you look at some of these services that are now going on in the US, yeah, they're getting pretty sophisticated. They're doing next dollar marginal investing, tax loss harvesting, risk assessment is going from stated preferences to revealed preferences. So there's some pretty good stuff, you know, going on in there in the fine judgment space. Empathy and trust, I think, as we were hearing earlier on, you know, still very, very strong attributes of the human. So I think it's an open question as to whether, you know, will human advisors always be there because of these attributes. If you just taking a snapshot of some of the things, this slide's a year old, and I couldn't get the data for this year, but roughly these numbers are about right. What we see on the left here is sort of pure robo plays. So Schwab's sort of entered the market a couple of years ago, big player now, they've got over 30 billion now. That's what I would call robo folio. It's kind of just automatic straight into a sort of a folio of that way. Betterment and Wealthfront got about 12 billion each now of assets. The reason people think Vanguard's got this right, we've got over 115 billion now in this. That's a service that's been going 3 years. I'll touch on that in a second. But you can see up there in the hybrid space, you've now got Betterment Premium, and you've got Schwab Intelligent Advisory. The difference is those have got humans in them. You can buy the digital-only offer, but you can also buy a slightly more expensive one that's now got the human in, and those are growing slightly faster than the existing digital-only base. I won't dwell on this. Vanguard's offer, Heather asked me to touch on. So Vanguard's personal advisor service, this is available to clients with 50,000 or more. It's 30 basis points is the cost of the service. The average cost of the portfolio in here is 8 basis points. So all in, you're paying 38 basis points all in for this service in the US. You can either go through the journey completely digitally if you want, or you can go through the journey completely with a human if you want, or any combination of the two. And we find that people start digitally, get stuck, have the human, go back to digital and so on. But people think we found the sweet spot here. If anything, it was a complete accident. The reason we have this service is because 4 or 5 years ago, the phone started ringing. We've got 8 million clients at Vanguard. When the phone rings, a lot of them start phoning you. And what we twigged, of course, is that boomers had started retiring and they were confused. So the only reason we had this service is because there was a demand for accumulation to decumulation advice in that way. Whether we found the sweet spot, but this combination of technology and people at that price point appears to be winning, hence why it's about 120 billion as we sit here today. So I guess just a couple of questions here then. So what are the challenges for the insurgents, those new technology-enabled platforms as we come through? What response are we seeing from the incumbents, and is there a path to profitability for any of them? There's a Morningstar report which is combined with PitchBook data, which looks at some of the fundraising that's been going on in this sector. Some, again, fascinating report if you want to read it from last year. They estimate that platforms are going to need somewhere between 16 and 40 billion in order to make any money. And it's nearer the 40 billion end if you're going to be priced at the 25 basis points bit of the market, which seems to be where the market is roughly settling. Not many of them are there yet at that level. Three challenges they have. Client acquisition costs are high, so roughly in the US, about $300 gross, about 1,000 net. So pretty high cost of client acquisition is a challenge for many. The cost of building operating leverage. So I think as we've heard a couple of times this morning, it would appear our industry doesn't scale because the operating cost and the cost of the consumer is the same whether you run a 200 billion organization or a 1 billion organization. The price seems to be the same and the cost seems to be the same. It appears fixed costs aren't fixed. So there's something going on with pricing. Either this industry can't scale or the benefits of those scale are not being passed on to the consumer. Certainly for the incumbents that are getting into this space, can they cannibalize themselves down? They're making this amount of margin, which they're either enjoying or they can't get it cheaper. So the question for some of the big incumbents is, can they get their business at an operating margin that allows them to operate? A good example is the PAS service that I've just described to you. We've got 700 financial advisors in that business now, and we can't hire them fast enough. So what we're trying to do is lean ever more into the tech. Otherwise, we're going to run out of advisors before we run out of clients. So even us, we still need to lean into the technology there. Revenue yield on client assets. Small balances kill you. Yeah. If you've got all that operating cost, then small balances really, really kill you. And a few of these services, I think when you look at the average balances, they are pretty low. So that can be difficult. For some of them, the payback period on a per client basis can be a decade or more. So I think certainly for the insurgents, it would appear that they've got some life or death choices. And you'll recognize this in some of the firms that you would have read about. Grow slowly in the hope that capital can continue to be raised in order to plug losses. Yeah. So to date, Betterment has raised $275 million of capital. Wealthfront has raised $200 million of capital. They've both got assets of about 12 billion. So they're both making about 30 million gross revenue. So some of the multiples look interesting when you see that. The multiples are coming down. When Wealthfront raised capital in 2014, its valuation was about 700 million. It raised another 75 million last year. Its valuation is now 500 million. So I think there is some realism creeping into the valuations of some of those organizations. Maybe the answer is to partner or merge with somebody if you're not going to make it. So we've seen quite a few of these. So BlackRock, Future Advisor, Fidelity, eMoney, GemStep, Invesco. We're starting to see the convergence of two things. You've got some firms with funky tech, but what they haven't got is brand and budget. Okay? We've got people over here with brand and budget, but they haven't got funky tech. And we're starting to see these two things join up. So maybe the route for some of these organizations is about partnership. Can you reach escape velocity, as I would call it, with a big advertising spend? In the US, again, Wealthfront and Betterment are the two that are seen to be sort of on the verge of going to make it, so maybe they can raise a bit of money and spend a fortune on advertising. Who knows? There's a robo advisor in the market today here in the UK that is advertising a £600 cash rebate on a 20 grand ISA. Okay, and at the amount they charge, that's 4.5 years of revenue they're giving back to the client. Yeah, that's a pretty strong client acquisition cost. Or maybe you evolve. So what we see is an evolution of the offer. So for example, we see Betterment for advisors. So they're going from B2C to B2B, or you upsell, i.e. the Betterment Premium. So rather than just the digital one, I can also upsell you into human advice if that's the way to go. So some pretty interesting choices for the early insurgents in this market. So I think we're left with a couple of open questions here, really. Will generational buying habits really change in favor of technology? Is it all going to become technology-driven? when the youngsters come through, albeit millennials can be 39 now, or actually, when they've got some money, do they think, no, I need a human? Don't know. Can insurgents reach escape velocity? Not a lot of evidence yet that they can. And can the incumbents cannibalize themselves to success? They've got high cost bases at the moment. Can they reconfigure themselves to really get this right with a much lower, when you're charging 25 basis points, not 125 basis points, can you reconfigure your business around that way? So open question as to whether any of these businesses can make it. I think Mike Goldstein has a nice quote in his paper, which is the importance of robo-advisors may not hinge on the assets they amass, but rather may have more to do with the track records that they make visible. The performance can represent a de facto benchmark for portfolios of real clients, something's been long missing. So I think what he's saying here is, whether they make it or not, all of a sudden they're shining a light on some very expensive things that clients have been paying for up now, both in terms of performance and service up to now. I kind of liken that to the days of stakeholder pensions here. Stakeholder didn't win, but what it did was create a new price point for pensions in the market, as it came about. And so that may be the legacy of these robo things, is they may not win, but they're going to shine a light on where the market really is and help people understand the performance and the price they've been getting up until now. So hopefully a useful 50 minutes. Thanks for listening.